All right, welcome, ladies and gentlemen, to the webinar today. Inflation is surging. What can an investor do about it? I'm excited to chat about what's going on in the markets today, the key risks and opportunities facing investors, and also some tools that you can have in your portfolio toolkit to help protect against the scourge of inflation. So let's get into it today. If you do have any questions, please put them in the text box, the question box. We can get to the questions at the end of the presentation. I'll try to keep it fairly brief today so we can have a discussion after if you want. So check out the disclaimer, forward-looking statements, estimates, things of that nature. Make sure you read this just so you understand all the risks regarding the language. All right, so kicking things off is really the basis, setting the table on what ultimately causes inflation. So if we look at the chart here on slide 3, we look at global debt levels on a debt to GDP basis. So if we look at the blue line, which is the one we're really concerned about, the median debt to GDP ratio of developed economies is now at an all-time high, basically exceeding the level it hit at the end of World War II and has more than tripled over the past 45 years. This is a massive concern. Now, how did this happen? Well, the big surge over the past 14 months was due to the COVID-19 pandemic. Governments were trying to rescue their economies from the extremely negative effects of the pandemic, basically shut down the economy, so had to enact record fiscal and monetary stimulus to combat that. I'm 100% supportive of the government actions. It was definitely the right move to support economies as we went through one of the worst pandemics ever, one of the worst recessions ever. So clearly they were right in that. However, we're stuck with a tremendous increase in debt. So I'm not saying that's good or bad. I'm saying it is what it is. And as an investor, we just need to deal with reality. And the reality is that debt levels are at all-time record highs. And I believe that current government debt burdens, the fiscal debt burdens, are too high to be supported by economic activity alone. And this is shown by the debt to GDP ratio, basically measuring the total federal debt versus the power of the economy. So once this happens, once a threshold is crossed where the economy can no longer support the level of debt, there's really one way and one way only out of this scenario, and that is through inflation or the reduction in the purchasing power of money. So to me, it seems inevitable you just got to look at where debt levels are, and largely, what was the catalyst? Well, that was COVID. So inflation, we're starting to see it everywhere. And why? Well, the reason why these record deficits over the past 14 months to support economies through the pandemic, well, how did this happen? That happened through record money printing. So in early 2020, governments unleashed a massive flood of stimulus. There's been an absolutely extraordinary growth rate in money supply. So the amount of money out there, if you can look at this chart on slide 4, has increased markedly over the past 14 months. In fact, M2 money supply has seen a 26% year-over-year increase, and M1 money supply up an absolute stunning over 300% year-over-year. Growth in M2 money supply is the largest gain since 1943. So we're really seeing unprecedented levels in the growth of money supply. And with that, it's no surprise that prices for goods and services are surging. Here is a price chart for used cars. Used car prices increasing double digits. Home prices increasing double digits. In fact, US home prices now exceed that of the previous bubble high and are increasing at a record rate. Not just that, but you see it in the prices of copper, You see it in the prices of food, of energy. Everywhere you look, seemingly prices are rising at a double-digit clip. And this is amidst record monetary stimulus. The Fed has shown basically no signal of tapering or slowing its quantitative easing, which currently is going to be maintained at 120 billion per month of quantitative easing in the face of record low fiscal and monetary easiness of policies. Like, policies are their easiest on record according to the Goldman Sachs index. And so as these higher and higher price levels get manifested through goods and services, people start realizing what's going on. Their power bill is going up. They want to buy a new car. It's significantly more expensive. They want to buy a new house. That's way, way more money than they expected. So if we look at the graph on page 6, this is the Google search trend for inflation, just by, everyday individuals. If we look at Google searches for inflation, these have basically doubled over the past year. So they're increasing dramatically. It's more than just anecdotal evidence. Consumers are starting to get very concerned. And this plays a psychological part of an inflationary mindset where they expect money to go down in price and therefore want to spend it on a car. They want to spend it on a home. They want to spend it on gold, which we'll get into. So that is an important consideration, is the thought of inflation has really entered the mind of the everyday consumer and society. And it's not just consumers, it's investors as well. Investor inflation expectations are at their highest level since 2006 and really show no signs of slowing down. So investors super concerned about inflation. I'm sure all of you are as well, which is why you're on the webinar today. Of course, I am, which is why I wanted to talk about it today. I think it's the biggest risk investors are facing in the current market environment. So we're here today to talk about certain investment strategies, certain assets that can perform in an inflationary environment. And we're now at the stage where the Federal Reserve can no longer deny inflation. They utilize core CPI, the Consumer Price Index, but many argue that this has a history of understating inflation. I would perhaps agree with that, but that's a discussion for another time period. What I'm saying with this observation is that the Fed can no longer deny the inflation that you and I and everyone else is now seeing in their everyday lives. They cannot deny that inflation has reared its ugly head. All the Fed can do is claim that it's transitory, and whether or not it is, that's to be seen. But the point being is we want to have risk management before it's too late. By the time inflation is out of control, the tools that we need to battle it will be way, way more expensive than they are now. So with that in mind, I wanted to talk about the 2 inflation fighting measures that investors have in their inflation fighting toolkit. So number 1, we want to focus on protecting purchasing power. And number 2, we want to focus on generating income. So with respect to protecting purchasing power, really we're concerned about fiat currencies rapidly devaluing. And so we want to not hold those, and we want instead to hold assets that will maintain their value over time, such that, if inflation is double digits, we can liquidate something that will be able to maintain its value to be able to fund our lifestyle. So number 2, generating income in an inflationary environment. Us as investors, we do not want fixed yields. We want assets that generate income in a floating rate manner. These can adjust to a higher yield environment, a higher rate environment, in which will happen in an inflationary environment. So these are the 2 inflation fighting measures that we're going to focus on in today's presentation. And I'm going to give an example of assets that you can buy for both of these buckets. Let's get into protecting purchasing power. Looking at the picture on the right should give every investor nightmares. This is wheelbarrow money, a huge concern. We've seen it in history, inflationary bouts, Venezuela, Zimbabwe. I'm not saying developed economies will see, inflation in the millions of percent, but nonetheless, this image strikes to the heart of every investor, and we need to be cautious when inflation starts presenting itself. And it has happened historically in developed economies as well. If you want to know more about this, read the book When Money Dies: The Nightmare of Deficit Spending, Devaluation, and Hyperinflation in Weimar Germany by Adam Ferguson. This happened less than 100 years ago in Germany, where their interest rate went to $1 per 4.2 trillion marks, and they did have to, wheelbarrow money actually wasn't even usable. They had to move to a barter society. But that's an extreme case. I'm not forecasting hyperinflation, but number one, we got to be concerned about protecting our wealth, insulating against a rapid decline in the value of money. How do we do that? We want scarce, valuable assets that will maintain their purchasing power. Here's how we're going to play it. We effectively have 4 assets in 2 buckets as tools that investors can incorporate into their investment portfolio to protect purchasing power in an inflationary environment. So the first bucket are alternative currencies. Alternative currencies act as a store of value. These are scarce assets. These are valuable assets. They're also liquid and can be converted into fiat currency whenever you'd like. So number one, gold has maintained purchasing power for thousands of years. There's an interesting anecdote that I believe was written a very, very long time ago, and it has withstood the test of time. And that is 1 ounce of gold should always buy a nice man's suit. That continues to be true today. It was true 500 years ago. It was true 2,000 years ago. To the extent that there were suits back then, that might be a bit of a stretch, but nonetheless, someone researched that. Number 2, Bitcoin. I like Bitcoin more than gold, but these are not mutually exclusive. I, in fact, own both Bitcoin and gold. I think they're both great at maintaining purchasing power. They're both scarce assets. They're both valuable assets that you can hold on to. And in the brackets here, I do give some examples of ETFs. So for gold, there's FIZ, there's GLD. For Bitcoin, there's BTCC, there's BTCX. Both those trade on the Toronto Stock Exchange. So that's the first bucket, alternative currencies consisting of gold and Bitcoin. The second bucket are so-called real assets. These can maintain purchasing power because they have income generating potential. These real assets include real estate, ETF would be CGR, and infrastructure. A couple ETFs for infrastructure include NFRA and ZGI. We call these 4 assets, gold, Bitcoin, real estate, and infrastructure, the 4 horsemen of the inflation apocalypse. And these are all core holdings in our Accelerate One Choice Alternative Portfolio ETF. Each of them have a 10% weight for 40% of the 1C portfolio. So I like gold, Bitcoin, real estate, and infrastructure. I think investors should have exposure to all of them. And what I'm discussing about today is not position 100% of a portfolio for an inflationary environment. It's to position a portion of one's portfolio, diversify into inflation protecting assets such that a portion of your portfolio is prepared for that. So in my opinion, the standard 60-40 portfolio in which the 40% is fixed income, we do not want that much fixed. On to generating income. And here's what I'm talking about. You look at fixed income today, the chart on the right, TLT, the bond ETF is in a bear market. It's down more than 20% from its high last fall. That's not safe. And I think it's going to get worse as interest rates climb in an inflationary environment. Fixed income will be absolutely punished, even worse than it has been. And if we look at what's happened, bond yields bottomed at 50 basis points on the 10-year last summer, and now they're in the kind of 1.5 to 1.7 range. What happens to fixed income as rates rise above 300 basis points? which is not out of the realm of possibilities. We want to de-emphasize the fixed income portion of our bond portfolio, our yield portfolio. We want floating rates. Floating rates should be emphasized in an inflationary environment because they can reset to higher yields that will come as inflation increases. So focus on floating, not fixed. How are we going to play it? There's a number of ways of generating more floating rate, adjustable, variable yield in an investor portfolio that can participate in rising yields that will happen as inflation goes higher. Now, this variable yield will offer you more and more income as inflation and yields increase. So there are two traditional floating rate investments that are accessible to investors. Number one, leveraged loans. These are just senior bank loans that have a variable rate. They're generally used to fund leverage buyouts, private equity buyouts. One example would be SRLN, the ETF. Second traditional floating rate investment includes rate reset preferred shares, whose yield or distribution gets reset according to a schedule. ZPR or ZPR would be one of these ETFs. There's another often missed way of generating a variable yield that can do well in a rising rate environment. So these are alternative floating rate investments. This includes merger arbitrage and SPAC arbitrage. So there's basically three great tools that we have to transfer some of your portfolio from fixed income to floating rate income. That includes leverage loans, that includes rate reset preferred shares, and that includes arbitrage. Those are three valuable tools an investor has to generate income in an inflationary environment. So touching on the arbitrage aspect, these charts on the right at the top, this is the merger arbitrage yield, currently around 700 basis points, 7%. I think that's pretty attractive. If we look at high yield bonds, they're at basically all-time low yields. Triple B corporate bond yields are like 240 basis points, very, very low. So you're getting excess spread in merger arbitrage. And since merger arbitrage is such short tenor, the average deal is about 4 months, it will on average adjust to rising rates. Rates in merger arbitrage are basically set off short-term treasuries. So if we look pre-COVID, 5% average merger arbitrage spread or annualized yield compared to pre-COVID T-bills at about 200 basis points. So historically, merger arbitrage was priced off a risk spread to T-bills of roughly 300 basis points or 3%. Now you can see with T-bills yielding roughly 0 and merger arbitrage yielding 7%, that risk arbitrage spread has gone from 300 basis points to 700 basis points. So extremely attractive floating rate yield in merger arbitrage. Then going down to the graph on the bottom is SPAC arbitrage effective yield. What you can generate by holding the average SPAC, buying it at a discount, and holding it into redemption. And what a SPAC at a discount represents is T-bills plus a spread for lack of or less liquidity. And if you buy all those, you can generate pretty decent yields, currently 120 basis points. And this ignores a couple things. It ignores upside optionality, of which the market was pricing in a significant amount earlier this year as yield dipped below -4, and that can be significant. So SPAC arbitrage yields extremely bearish or extremely unattractive in January and February, and they flipped to very attractive. In fact, SPAC arbitrage yields are at their most attractive level basically since April and May 2020. Not a lot of asset classes you can say are more or as attractive as they were just recovering from that brutal bear market. So to go over these three strategies and what they can provide in terms of floating rate. So senior bank loans, you can expect a yield of roughly 4%. Same with rate reset, preferred shares, roughly 4%. Combination of merger arbitrage and SPAC arbitrage, I believe would be higher, kind of in the 7 to 8% annualized range. So arbitrage, ultimately a strategy that offers that floating rate yield exposure that investors should seek in the current environment. Beauty is it's largely uncorrelated to traditional asset classes as well and can generate higher returns, I believe, than senior loans and rate reset preferred shares. But all of them are useful tools for an investor to have in their toolkit. How does one access arbitrage? Well, I run the Accelerate Arbitrage Fund ETF, symbol ARB, on the TSX. Does pay out a 3% distribution yield, which we boosted last year by double digits. Hopefully we can boost by the same again this year. Not just the yield, but as you can see on the chart on the right, pretty tremendous price appreciation, historical Sharpe ratio of 4. So it's a TSX listed ETF, ARB, that offers investors a portfolio of diversified SPAC and merger arbitrage opportunities. So to wrap things up, prior to getting to questions, inflation, I think it's the most significant risk facing investors today. We basically have two ways to protect against this. Number one, we want to protect purchasing power. We can do that through assets such as alternative currencies, including gold and Bitcoin, and assets including real assets such as infrastructure and real estate. The second way is to generate income through floating rate investments, including senior bank loans, including rate reset preferred shares, and including arbitrage. So we really want to protect our wealth. That's what we're looking to do. It's risk management before it's too late. I believe it's still early. Investors can get a good price for these assets. And by the time the majority of people start worrying about inflation, it'll be too late. These assets will be far, far more expensive. So we want to diversify. We want to position at least a portion of our portfolio to be able to protect our wealth in an inflationary environment because the signals are there. Record deficits, record debt, record money printing. We're seeing double-digit price increases in housing, food, energy, lumber, used cars, go on and on and on. So the signals are there. We got to prepare. It's not too late. Thankfully, investors have a handful of tools to, number one, maintain purchasing power, and number two, generate income on a floating rate basis. As interest rates rise, as inflation spikes, we need to protect our portfolio. So thank you for attending the webinar today, talking about inflation and what we can do about it. Here's my contact information. Feel free to send me an email, follow me on Twitter. We can chat about it. I would like to get into questions today, if you have any in the chat. I don't see any questions yet. Feel free to put some in there. I'll wait for about a minute, and if not, then we'll end things here. I hope you enjoyed it today. So thank you everyone for attending, and best of luck with your security selections. Okay, great. We got a question from Pierre. Thank you for the question. Pierre states, can you differentiate between arbitrage strategies' ability to adjust to increasing yields? Yes, this is a great question. And so their ability to adjust to increasing yields comes from two things. So number one, the short tenor. So if you have an arbitrage spread, it's priced off, call it 3-month T-bill yields, plus a risk spread. So as rates are going higher and the deals close, you get your money back after 3 months. The next deal will be priced at a wider spread. Say rates go to 2%, the next spread will be offering 5% instead of 3%, assuming that 300 basis point risk spread is there. Plus, merger arbitrage spreads will start pricing in higher yields as the market starts to sniff these out. Perhaps that's why yields are so high these days, to take that into account. But the reset nature of merger arbitrage is that the turnover is so high and the tenor is so low that you're consistently maturing merger arbitrage trades and moving on to the next one. So they adjust over time to a rising rate environment. Then on the SPAC side, SPACs are basically discounted short-term T-bills, right? And SPACs hold in trust T-bills of tenors 185 days or lower. So SPACs within their trusts, they're rolling over T-bills, every handful of months. And so as rates go up, SPACs will generate more accrued interest for investors. Plus, as new SPACs get issued, they'll perhaps trade at wider discounts to their net asset value to adjust to wider spreads. So versus rate reset preferreds, which are mechanically set based off a schedule, merger arbitrage spreads and the variable nature are more so set by the market. Hope that clarifies things. Any other questions? Feel free to put them in the chat. All right, another question from Pierre. What else is in 1C? 1C is the Accelerate One Choice Alternative Portfolio ETF. Good question. So the four assets that I discussed in maintaining purchasing power. So there are alternative currencies. Number one, there's 10 assets within 1C. So the first two are the alternative currencies, gold and Bitcoin. And the next bucket are real assets. Asset number 3 and 4, real estate and infrastructure. So 1C, 4 out of 10 of its assets can maintain purchasing power in an inflationary environment. That's Bitcoin, gold, real estate, and infrastructure. Then on the floating rate income side, the One Choice portfolio has arbitrage, so SPAC arbitrage and merger arbitrage. It has leveraged loans. So that's number 7. It also does have mortgages, has risk parity, and an alternative equity strategy. So 1C isn't 100% for inflation. It just includes the diversification benefits of these assets mentioned within the portfolio, just to further diversify investor portfolios. And it's all about protecting against certain economic environments, right? Like you ask someone, why do they own T-bills here? They're not generating much income, call it 1.6% on the 10-year. So deeply negative yield with an outlook for inflation. Well, the only reason people like owning them is so-called protection in a bear market, should it could happen. But last time I checked, bonds and stocks are at their most positively correlated in the past 22 years. So historically, they've been negatively correlated, which was why investors wanted bonds to protect against a drawdown in their equity portfolio. However, recently, they've flipped that relationship and they've been positively correlated. So it's all about preparing for different economic scenarios. I'm not saying inflation is for sure going to happen. I'm saying there's a decent chance of it happening. And if it does, you should be prepared before it's too late. Who knows, perhaps the Federal Reserve is right and it is transitory. So you hold some inflation protection assets in your portfolio. We're looking to protect, well, risk management before it's too late. Okay, another question. Looking for information on the Accelerated Arbitrage Fund ETF, ARB. How is the NAV determined and what are the drivers of the higher NAV in May 2021 versus October 2020 as an example? This question is from HG. Thank you for the question. So the NAV of ARB is calculated the same way as any ETF. It depends on the underlying securities held in that ETF. So ARB holds a diversified portfolio of SPAC and merger arbitrage opportunities, over 250 positions, so widely diversified, roughly 80% SPACs, 20% merger arbitrage. And why is it higher in May 2021 versus October 2020? Well, over time, like, we're generating high single-digit yields through arbitrage. And over time, the net asset value should increase. We do pay out a roughly 3% distribution yield, but we believe that we can generate higher returns in the 7 to 8% annualized range. So we'd expect to consistently generate high single-digit returns, pay out a 3% distribution yield, and hopefully be able to reward investors with 4 to 5% capital appreciation. Over the past year, we're up about 40%, so far above expectations. However, that year was an anomaly. We don't expect that to happen again. However, we have run this arbitrage mandate for over 7 years, 6 years as a private hedge fund, over 1 year as a public ETF. They've compounded at a double-digit annualized return with single-digit volatility and no major drawdowns. It is a low-risk strategy that generates an attractive alternative yield for investors, and should tick higher over time as we generate and basically crystallize those arbitrage spreads. Hope that helps. Okay, another one from Pierre. In your other alpha quant equity models, have you researched the impact of biasing allocations towards sectors particularly well positioned to pass along price increases from inflation to customers? It's an excellent question, Pierre. In terms of an equity strategy, if I understand it, you're proposing an equity strategy that would focus exclusively on businesses that capitalize and can do well in a rising rate environment. Certainly that makes sense. We don't offer a product like that. I can envision something that would be heavily into commodity producers, gold miners, etc. Copper miners come to mind. Lumber producers, you're certainly seeing in their stock prices these days. Lumber companies, copper companies, gold mining companies, Bitcoin companies, all of those would make sense from an equity allocation perspective. We don't currently offer that, but certainly from a stock picking methodology, I'm sure many PMs are considering that strategy as we speak. Great question, though. All right, I believe that's about it for questions. Thank you so much for joining me on the webinar on inflation today. Hope you enjoyed it. Hope you found value in it. Thank you for your questions. It was an interesting, compelling discussion. Feel free to contact me, reach out, phone, email, Twitter. Chat with you soon. Have a great day. Take care.